Passive Pockets is presented by Equity Trust.
Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Chris Lopez, the host of the show today. And today we're digging into retirement account strategies that every real estate investor should absolutely know. Our guest today is a friend of the pod, John Bowens from Equity Trust. John teaches us everything there is to know about how to use tax advantage accounts to buy real estate and alternative assets. So self-directed IRAs tend to get all the attention, but solo 401ks can be a powerful tool for investors with self-employment income. We'll cover what a solo 401k is, who qualifies, contribution limits for you and your spouse, Roth options and conversions, what UBIT is and how it's handled, and all the other items that you need to know about solo 401ks. We'll also ask John about Equity Trust's new 401k platform and fees so you know the real mechanics. Quick reminder about the episode today, it is for education purposes only. Always go out there and talk with your tax and legal professionals before making any moves. All right, let's jump in. John, I'm really excited to have you back on the podcast. Thank you, and how you doing?
I'm doing good, Chris. Thanks for having me again.
So John is always one of my most favorite people to talk to when it comes to like maximizing self-directed retirement accounts, because I'm all about like the who, not the how. And John is the who with all the knowledge. So we have a lot of details to jump into it. Before we jump into all the solo 401k stuff, John, give us just a quick background for our listeners who don't know about who you are and Equity Trust is.
Yeah, absolutely. I do have a background in real estate, so that's certainly where my passion lies. I came to Equity Trust nearly 20 years ago, and I met our company founder, and he's still the chairman of the board. His name is Dick Desich. He's widely known as the pioneer of the self-directed IRA industry. He started the origins of Equity Trust back in 1974 and with just a handful of clients. And now we have over 300,000 customers. We service customers in all 50 states and just over $72 billion in assets under custody and administration. In my role, I do a number of different things within Equity Trust, but my primary role is education and awareness. And it's providing instruction and information, not advice or recommendations, but education and information to real estate investors and other investors alike, but primarily real estate investors and how they can utilize self-directed IRAs, 401ks, HSAs. I know we're going to talk a lot about solo 401k plans here. So I spend a lot of time educating individuals as well as educating the masses on these different podcasts and these different programs. And, really big thank you to Passive Pockets and you, Chris, and your team members for helping us do that.
Well, thank you. Well, let's jump into it because I feel like, as an investor, self-directed IRAs, they're always in the spotlight, and then solo 401ks don't get nearly as much of attention. So I don't know if that's my perception, but would you agree with that or push back? Like, do solo 401ks often kind of get left out of the limelight?
Yeah, they do. And the reason for that is if we go back to the origins of the law, 1974, the Employee Retirement Income Securities Act of 1974. So since the mid to late 1970s, individuals have been using IRAs, call it self-directed IRAs, to invest in real estate and private startups and other alternative investments. Solo 401k plans, by virtue of laws that were passed by Congress, really didn't get instituted until the early 2000s. And so the reality is the solo 401k plan just hasn't been around as long as the self-directed traditional IRA, the self-directed SEP IRA, the self-directed Roth IRA. I also find that it's very much a topic and it's very much a plan that there's not a lot of education and not a lot of information out there about how it works and the real application of it. And that's something we're obviously trying to change here at Equity Trust and Passive Pockets, which is the purpose of this, is to help people understand what the solo 401k plan is and what are some of the attractive benefits that folks should consider. And then more importantly, the actual roll up the sleeves and practical how-to. How do you actually run one of these plans appropriately and effectively and maintain compliance along the way?
All right, so before we get into details, just walk us through about like the basics of what a solo 401k is and who can qualify for one.
Yeah, so the best way to think about it is a solo 401k plan is very similar to a 401k that you would have when you work at a W-2 job. So with a solo 401k plan, you're making a contribution, and those contributions are based on your self-employment taxable earnings. When you hear solo 401k plan, that means you as a self-employed individual. You will find there can be instances where you might have a spouse that is a participant of your solo 401k plan if you hire them in your business. But generally speaking, solo 401k plans are for self-employed individuals. Now, that could be you as a self-employed individual, sole proprietorship, where you're just doing business as yourself. For example, I work with a lot of real estate agents. They don't have an LLC or an LLC taxes and S corporation. They're just doing business as themselves. So they get 1099 commission and their self-employment taxable earnings. So think of it as their net income after their business expenses are accounted for. They have their net self-employment taxable income. And that amount is what supports the contributions to their solo 401k plan. Or maybe we have someone that has an LLC or an LLC taxes and S corporation. So they set up their solo 401k plan under that particular business. The best way to think about it is if someone is a self-employed individual, sole proprietorship, LLC, LLC taxes and S corporation, they most likely qualify for a solo 401k plan. We'll need to dig a little bit deeper into that, but just the Reader's Digest version, self-employed individuals, the solo 401k plan can be an ideal plan for them because it allows them to save for retirement, very similar to if they went and worked for a company, but they're doing it within their own business. And that was why Congress put this together back in the early 2000s when the laws were passed. They wanted to give a retirement plan to self-employed individuals that don't have access to pensions, don't have access to government pensions, don't have access to 401ks. And they wanted to make it easy. And so you'll find that a solo 401k plan can be very low cost, very easy to implement, and very easy to maintain. So a small business owner, self-employed individual, again, LLC taxes and S corporation, can easily maintain one of these plans without exorbitant costs or exorbitant administrative burden. And the highlights of a solo 401k plan, to answer that question, Chris, I give the 4 benefits. There are 4 primary benefits and why a solo 401k plan is so attractive for real estate investors. The first one is contributions. So with a solo 401k plan as a self-employed individual, again, I use the example of a real estate agent, but it could be someone flipping properties or someone that maybe does property management, right? You can kind of plug and play. Your consultants, your independent contractors, right? If they have enough self-employment taxable earnings, benefit number 1 is the ability to be able to make significantly high contributions on an annual basis. And I'll give you those exact numbers. If you're under the age of 50, you can contribute up to $70,000 in tax year 2025. If you're 50 and over, you can contribute up to $77,500. And then because of the Secure Act 2.0, Congress gave us the benefit if we're between the ages of 60 to 63, you can do what we call in the industry a super catch-up contribution, which brings us to $81,250. Now let's compare that to just an IRA contribution. So you brought up at the very beginning, Chris, self-directed IRAs have sort of seen all of the attention over all these years. Well, what about a solo 401k plan? With an IRA, call it a self-directed IRA, which again is just an industry term, you can contribute $7,000 a year when you're under the age of 50, and then $8,000 when you're 50 and over. So that's how much you take out of pocket and contribute. A solo 401k plan, we can contribute $70,000, $77,500 if we're 50 and over, $81,250. Now you can contribute to both. So you can max out your IRA contribution and max out your solo 401k plan contribution. You could also, let's say you're working a W-2 job, you're not an owner of the business, you're just working at that company. Can you contribute to that 401k and then also max out your solo 401k plan for your side business? The answer is absolutely. And a good example is I'm working with an anesthesiologist right now, and she works at a private clinic and she is making her W-2 income there. And then she also has her independent contracting, if you will, self-employed practice here. And so she goes out and works as an independent contractor for clinics as an anesthesiologist. So she's putting $23,500 into her workplace, call it W-2 401k. She doesn't own that clinic. She's just an employee of it. So she puts $23,500 in there. And then with her solo 401k plan, she does something called an employee non-deductible contribution that we can get into. It's much more detailed. The long and short of it is this, Chris. She's able to get $70,000 into that solo 401k plan. So she's not limited to 70,000 across the two 401k plans. They're treated separately. So she's actually getting across 401k plans, she's getting close to $100,000 across those two 401k plans in 1 year.
In my simplistic mind, she's making, it sounds like, I'll say, two of the employee contributions, the employee 23,500 contribution at her job, and then 23,500 on the employee side of her business, on top of what she can contribute as an employer.
You could say it that way, Chris. The more technical aspect of it is this. Your employee contribution with a 401k, including a solo 401k plan, there are three types of contributions. This is really important, by the way, for listeners. Three types of contributions. Now, not all 401k plans are designed the same. You've got to get the right provider that has the right plan design and system. So source or type number one contribution is what we call an employee contribution. Employee contribution, also known as an employee deferral. It's called a deferral because you take money out of your paycheck and defer it into the 401k. Your employee deferral contribution is $23,500 when you're under the age of 50, $31,000 when you're 50 and over. And that's across all 401k plans that you have. So in her case, she's got her 401k at her W-2 and her solo 401k plan. She gets one $23,500 contribution. She does that entirely to her 401k at her job. Then we move on to type number two, which is what's called a profit sharing contribution or a match if you're working for a company. A profit sharing contribution is what we typically do in a solo 401k plan. But then we move on to type number three, which is going to answer your question, Chris. Type number three is what we call an employee non-deductible contribution. It's like a Roth contribution, but it's not a Roth contribution. It's an employee non-deductible contribution. So source number three, type number three, she does a full $70,000 employee non-deductible contribution because she already did her employee contribution over here. She doesn't have any more of that. So she can only do that employee non-deductible. Now, interestingly, on the employee non-deductible, the reason why she does that is it's $70,000. That's all after tax. So she doesn't get a deduction for it. And then she immediately converts that over to the Roth side of the solo 401k plan, because the solo 401k plan, like we've talked about in other podcasts, you have pre-tax and you have Roth side. It's one plan, but you can contribute pre-tax or Roth. So she does all employee non-deductible and then converts it over to the Roth. In the industry, Chris, we call this the mega backdoor Roth contribution. So when you go online and you read all these different articles about mega backdoor contribution, that's all it is. It's just type number three, employee non-deductible, $70,000 in her example. She converts that over to the Roth. It's not double taxation, it's single taxation. And the beauty of that, Chris, is that $70,000 in that Roth is going to grow tax-free. When she distributes the money eventually in her retirement years, she pays 0% tax. Part of the reason why she is using a solo 401k, Chris, and you probably know where I'm going with this, is benefit number two of the solo 401k plan, which is when she invests in real estate syndications, which is what her investment strategy is. So as an individual investor, we're not advising her to do this, but she wants to invest in real estate syndications. That's what she's good at. That's what she knows. That's what she wants to do. And she's a passive investor. She doesn't have time to actively manage rental properties, but she knows how to do due diligence, and she has people that help her do due diligence on real estate syndicators. When she uses her solo 401k plan to invest in those real estate syndications, she will be exposed to no unrelated business income tax. When using an IRA, HSA, Roth IRA, when you're investing in real estate syndications or directly into debt-financed real estate transactions, you have unrelated business income tax. Now, that's not a deal breaker for IRA investors. Plenty of IRA investors do invest in UBIT generating transactions. But in this case, she qualifies for a solo 401k plan. So why not use a plan that's more tax efficient? And that's really the key here for investors, is use the account types, use the plans that are going to give you the optimal tax efficiency. And for folks investing in real estate syndications, if they qualify, the solo 401k plan is going to be the optimal tax efficient plan to use.
I totally agree with that. I've had a solo 401k plan for, I think I'm on year 5 or year 6 now. And I did a lot of research years ago, and the higher contribution limits were a huge attraction to me. And the no UBIT, I triple verified that because I was like, this seems too good to be true. And, it's not. But I want to jump back because I had never heard of that. You talked about that third type of contribution, the non-deductible employee contribution or mega backdoor, I think you called it. And I've never heard that before. Do most solo 401k plan types allow that? Or I'm assuming Equity Trust allows that? Because that's new to me.
Yep. So we absolutely allow it. It all comes down to the plan document. So solo 401k plans, unlike self-directed IRAs, have what's called a plan document. And these plan documents, it's very sensitive material. It has to be approved by the IRS tax exempted entity division. Now, you don't have to go to the IRS and do this. This is something that Equity Trust does with our different partners that we work with to put this all together in a turnkey solution for you. And so the plan document will prescribe if you have the ability to be able to do this. We do allow it because our clients, that's what they demand. They're interested in being able to put as much money away as possible into Roth. And so we need to offer that capability. Now, not all plans allow it. In fact, I'll say that many of the solo 401k plans that I've examined out there don't allow it, or they're trying to work towards adopting it, but they're not there yet. The other challenge we see in the industry is some record-keeping systems. When you open a solo 401k plan, you have a plan document and you have something called a record-keeping system. The problem that we see in the industry is some record-keeping systems require you to maintain multiple bank accounts or multiple brokerage accounts for each one of those sources: employee contributions, profit sharing, and then your employee non-deductible. Well, that can be very cumbersome and challenging, and you could potentially fall out of compliance if you're not careful. The beauty of the system that we utilize, this technology platform, is that you have one singular bank account. You make your contributions, the cash goes into one singular bank account, and then there's a record-keeping system where you input what are those contributions. You allocate what those contributions are. Is it employee? Is it profit sharing? Or is it employee non-deductible contributions? So it's really important that one utilizes the right technology system, the right record-keeping system, and has the right plan document that supports all this, because a lot of solo 401k plan systems, unfortunately, just don't accommodate these types of more creative, more advanced techniques that people want to use, especially around investing in real estate.
I think I have 7 or 8, for the benefit of accounts within my solo 401k. I think, 4 for my wife, 3 or 4 for me, IRA rollover, employee deferral, a profit share, Roth conversion. So it is just 7 times more bookkeeping. And I've been the last 2 years, a big part of me going from active to passive investing, real estate investing, has just been simplify, simplify, simplify. So you're saying with the way Equity Trust has their plan and the tech stack on there, it's essentially just one bank account and not 7 or 8 separate bank accounts?
That's correct.
Wow.
What I'll say is I'm glad you brought that up. You have rollover money, you have profit sharing money, you have employee contribution money. The record keeping system does need to tabulate and needs to document all of that. You're absolutely correct. But you don't need to have separate bank accounts for all those different, what we call money sources. You have one bank account. And the reason why you want to have that is, one, it's just easier. It's less maintenance. It's less admin work. But number 2, when you're making investments, you don't want to have to send money from this account and this account and this account. And then when your distributions come in, your quarterly preferred distributions, you don't want to have to figure out how to split those up, especially if you want to do Roth conversions, in-plan Roth conversions. So let's say you invest $50,000 in a real estate syndication, and you want to take $25,000 from your, call it pre-tax side, and $25,000 from your Roth side. And then maybe next year, you want to do an in-plan conversion, in-kind conversion of that other $25,000. Because some people want to spread their tax burden out over multiple years, converting from traditional to Roth. This record-keeping system allows you to do all of that without doing a bunch of brain damage to yourself and having to do a bunch of admin work. And the admin work is important from a compliance perspective as well. I've had clients that come to me and say, John, I'm trying to manage my solo 401k plan on a spreadsheet. And I said, well, why are you managing on a spreadsheet? And they said, well, the provider that I'm utilizing, they don't have a record keeping system for this. So I manage everything on a spreadsheet. Well, that's not the best way to manage a solo 401k plan. Now, let me be respectful to other solo 401k plan providers. The reality is this technology just didn't exist. This technology has only been around for about 3 to 4 years, and we're fully capable now and up and running on this. So it took quite a few years to get to where we're at. Keep in mind that solo 401k plans by law didn't exist until, again, the early 2000s. So we're only about 20 years into this. And the technology capabilities didn't exist until about 2015 to 2016. That's why you see a lot of these plans that just don't have all the bells and whistles that investors want.
I've got a couple of very selfish questions to ask for you on this podcast, John, for my own. Like I said, I'm a huge fan of the solo 401k. My current account is not with Equity Trust, but the more I'm talking with, the more I need to realize probably look at maybe transferring it over to you guys. So to recap, two things that excited me additionally was you were saying I can almost make a combined investment. Hey, if I put $100,000 in syndication, I can take a chunk here from my pre-tax, a chunk here from my Roth, and make that one investment. Because in my mind, I think in my current provider, my understanding, it's kind of like crossing the beams. I can't do that unless it's like two totally separate subscription docs and separate everything. But with Equity Trust, it can be one unified, simple accounting and simple investment.
Exactly. I'll give you an example. Let's say you're a sole proprietor. So you set up, you don't have an LLC or S Corp. I'm just using this as an example. So you set up the Chris Lopez Solo 401k plan. That's actually the name of your plan. You're the trustee of the plan. You're the business owner. You're the sole proprietor. Your self-employment taxable income is used to support the contributions to your solo 401k plan. And you can roll over money from a traditional IRA, a SEP IRA, a simple IRA, a 401k with an old employer, a TSP from an old employer, Roth money from an old employer. The only money that you can't roll into a solo 401k plan is a Roth IRA. But everything else, for the most part, you're going to be able to roll over in. Now, once your money is rolled over in, you've made your contributions, you want to make an investment. Let's say $100,000 in a real estate syndication. So you have the Chris Lopez Solo 401k plan. So when you fill out your subscription documents, you're going to fill out those subscription documents, Chris Lopez Solo 401k plan, trustee Chris Lopez. And Chris Lopez, as the trustee, is going to sign the subscription agreement because you're the trustee of the Solo 401k plan. Really easy. You're going to wire transfer. You're going to go into your portal and you're going to initiate a wire transfer from your bank account in the amount of $100,000 from the Solo 401k plan out to the investment sponsor. And you might have $50,000 come from traditional and $50,000 come from Roth. You don't have to fill out two separate subscription agreements. You don't have to get overly technical and say 50-50 here. It's one plan. Within the plan, you have traditional and Roth money, pre-tax and Roth money. You designate that in the record keeping system. And now maybe you say, Chris, hey, my strategy here is next year, because of my tax situation, I'm going to convert that asset in kind, that $50,000 that's in traditional, I'm going to convert that over to Roth. I'm going to pay the taxes in 2026, let's say. You have the capability of doing that. You don't have to go back to the investment sponsor and say, hey, I updated this and now you need to make your changes on your records and the ACH distributions that come back have to be allocated differently. You don't have to worry about that. The ACH distribution, one payment goes into your Solo 401k plan banking system, and then you tell the system, is it traditional? Is it Roth? What source is it from? So if you did do a 50-50, when those payments come in, you would designate 50 is going into traditional, 50 is going into Roth. And when you convert it over to Roth, using my example, then all you have to do is tell the system when the payments come in, this is all Roth money. The beauty of a Solo 401k plan is it can be self-trusteed. Sometimes in the industry, you'll hear self-custodied. So you don't have to have a custodian. Now, you do need to have a record-keeping system. You need to have a plan document. You need to make sure you're in compliance. If you're required to file 5500s, you need to make sure that you comply with that. So Equity Trust, we do serve as a service provider for all of that, but we don't need to be the custodian in that case because you can self-custody or self-trustee. Section 401F of the Internal Revenue Code. It's interesting how solo 401k plans work a little differently than self-directed IRAs. And you have what we refer to in the industry as checkbook control with the solo 401k plan. Now, when I say all that, you also need to understand you need to follow the prohibited transaction rules under Internal Revenue Code 4975, self-dealing. You need to make sure that you study up on those rules to not engage in a prohibited transaction. If you're investing passively into real estate syndications where you're not a general partner on, if you're making private money loans secured by real estate to other investors, not yourself, you shouldn't have much to worry about. But I just add in there that it's important that you understand that there are those prohibited transaction rules that you have to abide by. But to go back to your question, Chris, the record keeping system allows you to maintain one bank account. And when you're making investments, you're making those investments in the name of the solo 401k plan. And the solo 401k plan will have its own tax ID number, employee identification number. So on your K1s that you get every year that show the income or losses attributed to your solo 401k plan, it's being reported not to your business, not to you, but directly to your solo 401k plan.
I have one more question on this topic before I want to change gears here. So, at the Passive Pocket Summit, you were one of the presenters up there and you were talking about the benefits, and you had mentioned, I think you guys rolled out a lot of this new technology platform then, I think like soon after the summit in May. And there's on my list, hey, once it rolls out and give it a month or two for any rollout bugs to be worked out, I want to come talk with you guys, right? Is kind of my approach. So I am extremely intrigued, not just from the technology standpoint, but as I learn more of these nuances about rolling it over, how much hand-holding do you or Equity Trust do in just say 401k rollovers? Because I have lots of accounts. My record keeping is there, but it's on the spreadsheet. It's a little messy, right? I have multiple accounts into investments and things like that. How much hand-holding would I get or other investors?
The way we work is you open the plan and it's a complete online digital experience. You can have your plan open in under 10 minutes. Whether you're opening a new plan and just making contributions, rolling cash in, or like in your case, Chris, you already have a solo 401k plan and you're going to do what we call a plan transfer. I also like to call it a plan takeover, or just to help people understand what we're talking about, it's like a transplant. So you have one service provider and you're going to take your plan and you're going to reinstate and amend the new plan with a new service provider, Equity Trust. And so what we do is we help you establish the new plan. It's called a restatement, an amendment. So you get your updated plan document so that you can take advantage of everything that you want to take advantage of. You get the record keeping system. At that point, you then send a letter to your current solo 401k plan provider that says, hey, I want to terminate your service. You're not terminating the plan because, Chris, really important for you and everyone else, do not terminate your plan, because if you try to terminate your plan and roll it over, you actually have to wait 12 months and a day from the time you terminate a plan to open a new plan. So you need to do a plan transfer. Now, you have spreadsheets, which is good. Here's what we're going to do. We're going to work with you when you're ready to completely transfer the plan and all the assets. You're going to go into the record keeping system and you're going to insert all the assets, the dollar amounts, based on your spreadsheet. So it's not an overly complicated process. To answer your question regarding service, once you open your solo 401k plan, which you can get done in under 10 minutes, probably for you because you already have a plan and you have some experience, you could probably get it done in under 5 minutes. Your plan is open. So that's simple. And then you're going to get a phone call. We call it an onboarding call, where our solo 401k specialists, so these are people that have a lot of years of experience with solo 401k plans, they reach out to you, get a single point of contact that works on this team, and they will connect with you and walk you through those different components. And it goes beyond just what we're talking about here. For example, if you want to roll money over from an IRA or an old 401k, they'll help you with that process. When you're ready to make your first investment and you want us to walk you through how you complete that first transaction, how you upload documents into the portal, how you allocate traditional Roth. When you make contributions, how do you do that? We're there to walk you through that process. In your plan platform, when you log in, you have the phone number, email address, and then also a little chat icon where you can chat us and we answer questions that way as well.
Okay. I'm definitely going to follow up with you and then you can point me in the right direction on how I get started on there, because I'm extremely interested. And then I will document and share with everyone else, because I'm a big believer in solo 401ks. and a lot of the nuances you've talked about. The high level takeaways for me is it simplifies a lot of things for me as the trustee and, keeping records. And anytime I can simplify admin, big win. And sounds like too, you have some nice nuances on there too that helps me just get more money funded into my solo 401k as well. All right. So with the solo 401k, I got a couple questions on here as far as like having other employees. And I think you have to have like a common law employee, I think is a proper term, and correct me if I'm wrong. And a lot of times people have like their spouse on there. So the first part of the question is, can people add their spouse? The second question is, my kids are starting to get older, and I've been seeing a lot of, information on how parents put their kids on payroll to help shelter taxes efficiently. And a lot of times then have the kids, contribute to a Roth. So first part, hey, can you add the spouse? Second part, can kids be incorporated into the payroll and or into the solo 401k plan?
Yes. So with the solo 401k plan, a good way to think about it is to be eligible for a solo 401k plan. There's two major components here. Number one, you do have to have self-employment taxable earnings. What's self-employment taxable earnings? Best way to think about it, it's you providing a service, or selling something, like real estate, for example. Now, it doesn't have to be a lot of self-employment taxable earnings. For example, maybe you only have a couple $1,000s in 1099 income, self-employment taxable earnings, and you make maybe a $500 or $1,000 contribution. That would be okay. What you want to make sure of is that you don't open a solo 401k plan, have zero self-employment taxable earnings, and never make a contribution to the solo 401k plan. The reason why is because you could end up in what's called a plan failure status. The plan could become ineligible. The IRS on the website, irs.gov, it actually clearly states that contributions to a qualified plan, which a solo 401k plan would be a qualified plan, must be recurring and substantial. And they specifically state, they reference 3 out of the last 5 years. So in other words, contributions should be going in there in 3 out of the last 5 years. That is to the solo 401k plan. If you don't have any self-employment taxable earnings, then how are you going to make a contribution and be eligible? Now, it's facts and circumstances. So a lot of people ask me, well, John, what's the minimum amount that I need to report? What's the minimum amount of self-employment taxable earnings? I can't give you that number. And I talk to CPAs and tax attorneys all the time, and no one can really give you that number. It's an optics thing. So maybe it's $2,000 and you put $1,000 contribution in there. Just think about the optics of it. If you pay yourself $5 and put $3 in the solo 401k plan, that's probably going to look a little suspicious, right? Make sure that you're working with your CPA or tax professional on what should you do based on your specific facts and circumstances. So now the second item, that's self-employment taxable earnings. And if you think about it in the gig economy now, there's so many ways that you could qualify for a solo 401k plan. I'll give you a good example. I'm working with someone that's semi-retired. He's an engineer and he is close to 80 years old now. And his whole investment strategy is investing in real estate syndications. And he said, well, John, if I roll over this $400,000 from my traditional IRA into a self-directed traditional IRA and I invest in these 4 real estate syndications, I'm going to have to pay a lot of unrelated business income tax eventually when the properties sell. And I said, well, yeah, you could look at a solo 401k plan, but you have to be eligible. Here's how it works. He goes, I've been an engineer for a number of years, and I still do a little bit of consulting work. He goes, I was thinking about maybe not doing any this year. He goes, but now that I understand this, he goes, I'll pick up a couple jobs and I'll probably only make about $5,000 to $6,000, but I can make a little bit of a contribution to the solo 401k plan that maintains the status of the solo 401k plan. And now I can take advantage of that much more favorable UBIT exemption under section 514C9A of the tax code. That's really, really important. I mentioned that before. So last but not least, the second important qualification is no W-2 employees, no rank and file W-2 employees, unless an exception has been met. What are those exceptions? Well, you're the number one exception, right? Because you're the trustee, you're the business owner. So you're a W-2 in the business, you're the business owner, that's fine. You still qualify for a solo 401k plan. The second exception is going to be your spouse. This is an important one because your spouse doesn't even have to be an owner in the business. Now, maybe it makes sense for them to be an owner in the business. That's something for you to work out with your tax professional separately. But let's say you own the business and you employ your spouse. Great. Employ your spouse, and now your spouse can come in under the solo 401k plan as a participant. You don't have to have them set up their own solo 401k plan and pay an entirely separate fee. All you do with a few clicks of a button is add them as a participant to the plan. And if you think about it, if you're paying your spouse enough, if they're legitimately working in the business and you're paying them enough, you can make your full $70,000 contribution and they could have their full $70,000 contribution going into the plan, providing that you have enough income that you're paying each other, whether it's an S-Corp W-2 or it's just structured as some sort of partnership. Obviously, those are more details there. The idea is you can both make contributions to your own participant level accounts within the solo 401k plan. So no rank and file W-2 employees. I mentioned those exceptions. There are a few other narrow exceptions. One would be anyone that's under the age of 21. If you set up a solo 401k plan and then you hire someone that's under the age of 21, you don't have to offer them a 401k benefit, which means you can continue to maintain a solo 401k plan. But once they reach the age of 21, then at that point, you're going to need to offer them a 401k benefit, which means you're going to have to transition your solo 401k plan into a multi-participant 401k plan, which does happen for some people because their businesses grow and it's just inevitable that they got to hire W-2s and there's no way around it. When you open your solo 401k plan for the very first time, there's something called immediate eligibility. So if you say, hey, I got somebody that's under 21, and let's assume they're not a child. They're under 21, it's your nephew, let's say. And your nephew's working in the business, they're under 21. You set up a solo 401k plan for the very first time, guess what? You got to offer the benefit to them. So there are some odd nuances that you need to work through and think through. But as a general rule, you can exclude people that are under 21. You can also exclude people that haven't worked 1,000 hours in the last 12 months. And then you can exclude part-time employees that are under 500 hours for the last 2 consecutive years. So there can be instances where you have W-2 employees and can still maintain a solo 401k plan. But Chris, I'll tell you, you can tell this is getting real technical here. If you have rank and file W-2s, a solo 401k plan is probably not going to work for you. The last thing I'll mention in here, Chris, is there's an area of the tax law that can get very complex called control group rules. What are control group rules as it relates to 401ks? Well, here's what it is. The government, Congress, the IRS, the Department of Labor, they do not want us business owners taking advantage of a 401k benefit and not giving it to eligible W-2 employees. That's what they're trying to stop here. So they came up with these rules called controlled group rules. And here's the Reader's Digest version. It gets more technical than this, but I'm going to give you the Reader's Digest version. Let's say I have company A and I own 100% of company A. And I got 10 W-2 employees. They're over 21. They're full-time employees, okay? I set up company B, and company B I own 100% of, but company B doesn't have any W-2 employees. So I think in my mind, entrepreneur, business owner, I'm going to take advantage of a solo 401k over here with company B because I don't have any W-2s and not give a 401k benefit to company A employees. The government says that those two businesses are in a controlled group. Thus, I have to give a 401k benefit to the W-2 employees here if I'm going to take a 401k benefit, which means I don't qualify for a solo 401k plan. Now, I'm giving you a very simplified version of that. There's an 80% rule. If I and my spouse's ownership interests combined own 80% or more of multiple companies, those companies are going to be in a control group. Thus, if I have a solo 401k plan and I have W-2 employees, I got to give the benefit to those employees. Now, if I have multiple businesses, but I don't have any W-2 employees, guess what? I don't have to worry about it because I don't have W-2 employees. I'm not going to discriminate against someone and not give them a 401k benefit. Now, let me get to the heart of your real question, Chris, which is your kids. Interestingly, if you have children under the age of 21, you can still have a solo 401k plan because your children's ownership interest is actually attributed to your ownership interest. And there's another interesting exception to the no W-2 employees, business partners. If you have a business partner that owns 5% or more of your company, and they're also an employee, you can still have a solo 401k plan. In fact, you have one plan and you're both participants of the plan. So let's say, Chris, you and I have a partnership together, 50-50. Just use that as an example. And we don't have any W-2 employees. It's just us. We don't have to set up a multi-participant 401k and pay the extra money and the other extra complexity. We can open a solo 401k plan and each be participants of it. Now, once your children reach 21, you no longer have what's called the family attribution rules. And so what you would do at that point is you might consider transitioning ownership to your children in that business. Maybe you give them 5% equity or 10% equity, however that works out. So that way you can continue to maintain a solo 401k plan and they can continue to be a participant and make contributions as well. All along the way, they have earned income. So can they also contribute to IRAs, including a Roth IRA? The answer is absolutely.
So they can contribute to a Roth IRA or the solo 401k?
That is correct, yes.
Okay. Wow. John, this has been a phenomenal podcast. I could talk to you for another 2 hours, but I know we're over time. I love nerding out with you. I love getting the details. And for our Passive Pockets listeners out there, I'm a big proponent of self-directed retirement accounts, especially the solo 401ks. So educate yourself, see if it makes sense. Secondly, if you do go out there and start one or have one, I would definitely put Equity Trust at the top of your list as one that companies go out there and talk with. As you can tell, John is incredibly knowledgeable. The other thing I've noticed as my years as an investor and doing some deals is, from my perspective, it seems like Equity Trust, I mean, you guys are a fairly big company, which gives you a lot more scale, which I think gives you the ability to go out there and offer these tech platforms and be updating your plan documents versus, I'll say, a smaller, company. And that's not good or bad, it's just a fact. Hey, it takes a certain amount of scale to hire the lawyers and the fees, whatever, to go out there and pay it. Big shout out to John and Equity Trust. Go to their resource center, lots of great education. If you're interested in opening an account, definitely go out there and talk with John and his team because they are extremely knowledgeable. I know many investors who go out there and use them. So thank you again, John.
Yeah, you're welcome, Chris. I appreciate it. And some of the other educational videos that we've done, we've talked about, for example, unrelated business income tax. Just to quickly double click on that, and it is a lengthier conversation, but I think it's really important for investors to understand that when their IRA, traditional Roth, SEP IRA, is investing in a debt finance real estate transaction, it's inevitable, unless the deal's not profitable, that you're going to have unrelated business income tax. Now, that's not an overly negative aspect of using a self-directed IRA to invest in debt finance real estate transactions. People do it all the time. And for those that need a little bit more education on this, I'll give you a real high-level example. Let's say my IRA buys a property for $200,000 and I borrow $100,000. So I'm 50% leveraged. So I'm going to pay unrelated business income tax on 50% of my net gains. Now that's net gains. So that's after your operating expenses and depreciation. So a lot of that might get wiped out. A lot of the income might get wiped out. I may even have losses that can be carried forward to offset future gains under this unrelated business income tax. That's inevitable with an IRA, as I mentioned, if there's profits in the deal. When you're investing in a debt finance real estate syndication, same rule applies. So if I invest in a real estate syndication and it's, let's say 70% leveraged, I'm going to pay taxes on 70% of my net gains. Now I need to look at, okay, are there losses and how much of those losses are going to carry forward? That's pretty routine in the industry as I see, but inevitably you're going to pay some unrelated business income tax. And to give you an example, I have a client, he used a self-directed IRA to invest in a real estate syndication. It was 70% leveraged, 70% of the net gain. It was about a 3-year deal. It was a very profitable deal, I'll say. Okay, it's not your typical real estate syndication. 115,000 of the about 164,000 in capital gains was subject to UBIT, because not 100% of your capital gains is subject to UBIT. It's just the percentage that is applicable or the percentage that applies to the debt finance percentage. So it was 70%. So he had to pay taxes on about 115,000. His UBIT tax, his unrelated business income tax, was about $23,000. So he paid $23,000 in taxes, but his return on investment was still 47%. Now, this was in a traditional IRA, Chris. So I wish that he would have called me before. And I'll tell you, he qualified for a solo 401k plan. So what he could have done is rolled over his traditional IRA into a solo 401k plan, made his investment in that real estate syndication, and saved over $20,000 in taxes. I see this type of stuff all the time. It's just investors are not educated, or they don't have the right platform, or they didn't talk to the right person. And so don't be afraid of unrelated business income tax. Like if you're in a situation where you don't qualify for a solo 401k plan, but the returns are still good enough net of the UBIT tax, it might still make sense to do that. But if you can do it in a more tax efficient manner in a solo 401k plan, why not do that? That's within Section 514C9A. Not all forms of UBIT are exempt in a solo 401k plan, but with respect to debt finance real estate transactions, in 98% of instances, you're going to be exempt from UBIT if you do it with a solo 401k plan.
That is a great thing to add in there. I highly recommend everyone to go out there and understand it. Whether you have a traditional IRA, I've talked to a few investors who didn't understand that, and after a couple of years, they got kind of bit in the butt with some, taxes and penalties. And then also, if you can go out there and get a solo 401k plan, even create a side hustle to go in there and have it and maybe roll it over there, awesome thing to look at and see how it impacts your numbers. John, big thank you again. I always appreciate your time and your expertise.
Thank you, Chris. Appreciate it.
Today, we clarified when a solo 401k can beat a self-directed IRA and how to maximize your contributions and some Roth strategies, what to expect on UBIT, and what to do if your eligibility changes. So a big thank you to John Bowens and Equity Trust for the practical walkthrough. If this helped you pressure test your retirement strategy, subscribe and join the conversations at PassivePockets.com for due diligence tools and more community insights. Thanks for listening and happy investing.